Tyler, let's talk some dividend stocks. Let's talk a little bit of yield. There's some opportunity out there. Interest rates have come down. They might keep coming down. There's some expectation they're going to come down next year. Maybe go up or hold steady. Either way, people are looking for a little bit more yield and maybe the ability to see that yield grow over time. So we've got a couple stocks to talk about.
Yeah, and of all the places in the market today, dividend yielding stuff is actually starting to look attractive again, or at least certainly the ones that we're going to talk about today.
No, that's right. Momentum has grabbed the market by the reins, and there are a lot of things that continue to run higher. We see opportunity here. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas than the two we're going to talk about now, you should go check out our special link. It's fool.com/unscripted. Go check out that link and you can get access to the Motley Fool's 10 best stocks to buy right now. Take the time to check it out. Again, fool.com/unscripted. All right, Tyler, how about you kick us off?
All right. I think I've done this one a couple times with you before, but I keep going back to the well because it continues to be what I think is one of the more attractive options out there on the market today. The company is MPLX, company in the ticker are the exact same thing. So that's nice and handy and easy to remember. MPLX is a master limited partnership that is the kind of pipeline gathering system logistics subsidiary of the oil refiner Marathon Petroleum. So we're, getting pretty deep down the list on where it is in terms of the pecking order of the oil and gas industry. But one of the reasons that I like this business in particular, number one, the midstream aspect of the oil and gas industry tends to be one of the more stable ones. It's very much based on volumes, specifically with MPLX's assets being, volumes of product moving through North America. Almost all of it's in the United States. And I think that's important because, with the advent of shale, we've kind of had this revolution of increased production in the United States, which it seems unprecedented. You and I used to talk about oil a lot more during the 2010s when it was booming. And it's not a stretch of the imagination to say that kind of the shale boom has been an energy miracle for the United States in terms of what it has done in terms of energy production and things like that.
Despite what you may hear on the political talk news channels, the US is a dominant producer of oil and natural gas. Record levels. We've never produced more oil, never produced more natural gas than we're producing right now in this country. So wherever you stand on the political divide, MPLX is a massive beneficiary of what is already happening, no matter who's sitting in the Oval Office. And that's really, really important.
So we have lots of product that needs to get moved from place to place, and MPLX has the infrastructure to do it. It's mostly crude oil, refined product, and natural gas, with the most of it being on the crude oil side because it's feeding a lot of Marathon Petroleum's refineries. What I think makes it attractive is almost all of its production is done on long-term take or pay contracts, which basically means they're going to get paid regardless if somebody wants to use the space on the pipeline or not. And they tend to be very, very long term, very predictable revenue streams, unlike kind of the commodity ups and downs that you see in like oil and gas production, the independence.
That middle part of the oil and gas value chain, Tyler, is so valuable for people that are looking for predictability, particularly predictable income and some ability to grow that income over time and want to avoid like the volatility of what they're going to get. Because all the volatility happens on the two ends, right? It happens for the producers on the commodity prices, and it happens for consumers on the selling price of those refined products and commodities. So all the variabilities on the ends, and in the middle, these companies sit, like you said, they collect their fees, they make their money, and they send a portion of it back to shareholders.
As I mentioned, it's a master limited partnership, which means it distributes a lot of its cash because you are technically responsible to pay the income taxes of the business or the partnership. So if this is not one for your retirement accounts, this is for holding in a brokerage instead. That's a long conversation that we can probably do in another video about taxes and master limited partnerships. But for just sticking to the business itself, the reason that I like this, and I mentioned the industry dynamics, but specifically, I tend towards MPLX because management has shown over the past several years to be one of the better in terms of value creation. Some of the things that they do, they keep a very modest balance sheet with, debt to EBITDA in the low 3.2, 3.0 range, which for this type of industry is very low. Typically, you see companies levered up to 4, 5, 6 times in this industry, but not this one. Their returns on capital seem to be some of the better in the business, so they're really good at picking their spots and what they actually want to invest in, and they have a good history of raising their dividend without significant cuts or anything like that, and some of the management shenanigans that you get from, maybe less reputable operators. Marathon Petroleum is its largest shareholder by a significant amount, it's like 60%, and Marathon wants this to be a stable cash generator for it, so it manages the business in that very way. You have a business right now at its current yield, it trades at about 7.8% for its dividend yield. And over the past 10 years, it's grown it at about a 10% rate. So you have a good business growing a dividend yield at a modest rate, pretty good. 10% is actually quite good. But for that yield of 7.7 with a 10% growth, I think there's not a lot of other companies with high yield where you're going to get that kind of growth component. And that's one of the reasons I just seem to keep coming back to this one. I know I think I've mentioned it with you a lot, but the value proposition has always been there. And until we start seeing this thing trading at much, much lower yields, I don't see a reason why I would want to pick a whole lot of other high yield options.
Yeah, I'm glad you said that because a lot of people will look at the stock and the fact that it's yielded higher in the past and like, well, that's overvalued now. It's like, no, it was very deeply discounted for a long time and the
Very.
market's starting to kind of see some of that value there a little bit more. So again, 7% yield, that's a wonderful yield, especially one that you can count on from MPLX. So I'm gonna go in a little bit different direction, but I'm gonna stay in the same general area. Let's still talk about energy. I'm gonna talk about a part of the energy market that's kind of getting looked on a little bit less with less favor right now since the election of Donald Trump, and that's the renewable energy space. But where I'm going to stay in this kind of the same area is these predictable long-term generators of value. And I'm going to talk about one of my favorite yield codes. I'm going to talk about Brookfield Renewable. So Brookfield Renewable, it's also a publicly traded partnership, but there's also a corporation as well. BEPC is the corporation, BEP is the limited partnership. So this is one you can own in your retirement accounts. There's a mechanism to be able to do that really easily. But here's where I think it's really compelling. So something you and I talked about, Tyler, this is what investors might look at and say, wow, this one's way down over the past few years. And that's true. But if you look at it over the long term, it's been a massive winner and a wonderful value creator. And I'll explain why it's down so much and why I think it's quote unquote, maybe a loser you want to buy right now. And why it's been a long-term winner is the reason why. So the reason it's down is you go back to that 2021, 2020 period. We saw so many stocks just go to the moons. Everybody had diamond hands that they didn't really have. And renewable energy was an area that was really compelling. Now, these stocks got pulled into that because it is a renewable energy business. The stock was wildly overvalued. We saw the dividend fall below 3%, which made no sense based on kind of the growth trajectory and prospects. And like a lot of the SaaS stocks, all the other internet stocks and things that went up so much, they came down a ton and a lot are still down. That's still kind of the case. The stock's still down from kind of that euphoric high. But again, you look at the long term, it's still a big, big winner because management does a great job buying value, creating opportunity, and then selling assets where they can net a really good multiple and then recycle that capital into the next opportunity to buy at a value and then grow that asset over time and then generate really good value over time. So the way the company makes money is they invest in renewable energy, utility scale largely, some commercial, and some distributed renewable projects like wind and solar. They own a bunch of hydroelectric dams too. These things generate earnings on long-term contracts, like 15-year, 10, 15, 20-year contracts. Their customers are utilities, and large power buyers. So think about like Amazon or Microsoft, these companies, which again, to me, this is part of like the thesis of why now looks really attractive to these businesses because they're still signing these long-term agreements for renewable and low carbon energy to power AI. So there's a lot of money that's flowing to these businesses on these long-term contracts. And we're going to need to add more and more of these facilities that they invest in and build to generate that low carbon power. But since the election, we've seen Brookfield Renewable stock fall, 7 or 8% because of concerns about the incentives for the renewable energy industry getting gutted. I'm of the mind that we've seen lots of people running for office make promises, and very few of those promises actually ever make it to legislation. So for me, that's an important thing to remember. Again, that's not a partisan position. It doesn't matter the color of the tie, the person that's running for office. They make promises that they don't always deliver in legislation. So I think the industry is largely insulated. And the most important thing, Tyler, is that the tailwinds are massive and the economics are really appealing. And Brookfield is one of the best capital allocators in any industry that I know of. And I have faith in them being really good capital allocators and creating value. The dividend yield is approaching 6% on the limited partnership. I think it's around 5% for the corporation, BEPC. That's an attractive yield. And using it as a bit of a proxy for valuation, I think it makes sense. And now is a good time to be buying it. I think you hold it for the long term. There's always going to be uncertainty in every market environment. At some point, there's going to be uncertainty you go through, but the predictable aspect is they know how to invest well. They know which assets to buy and create value for their shareholders over the long term. So I think now's a really good time to be looking at Brookfield Renewable.